Have you ever wondered why so many people fail to make a profit in the stock market despite its long-term upward trend? A question that baffles many, and yet the answer might just lie in the realm of common sense. Let's talk about John Bogle, a name that resonates with every investor. He's the founder of the Vanguard Group, one of the world's largest investment companies, and the creator of the first index fund. This man, with his wisdom and experience, penned down the Little Book of Common Sense Investing. The title itself hints at the core premise of the book. Investing should be about common sense. Now, what does that mean? It's simple. Bogle argues that investing is not about chasing the next big thing or jumping on the latest trend. It's about steady, long-term growth. It's about understanding that the stock market, while volatile in the short term, has historically trended upwards. And how do we capitalize on this trend? Through low-cost index funds. You see, Bogle's book challenges the traditional approach of active investing. It exposes the harsh reality that most investment funds, with their high fees and inconsistent performances, fail to outperform the market in the long term. Instead, he proposes a different strategy, one that is simple, cost-effective, and more importantly, effective. This strategy is the backbone of passive investing in low-cost index funds that track the overall market. The idea is to ride the market wave rather than trying to outsmart it, to focus on the long-term upward trend instead of the short-term fluctuations. It's about understanding that investing is a marathon, not a sprint. It's about embracing the power of simplicity and patience over complexity and haste. And yet, despite its simplicity and proven effectiveness, this approach is often overlooked. We are lured by the promise of quick riches and the thrill of the gamble. We are drawn to the allure of high-risk, high-reward investing, ignoring the fact that the simple approach often yields better results. So why are we often drawn to the allure of high-risk, high-reward investing when the simple approach often yields better results? Perhaps it's time we start using a little more common sense in our investing strategies. Is simplicity the key to successful investing? Let's delve into this major theme present in John Bogle's book, The Little Book of Common Sense Investing. Bogle's philosophy revolves around the power of simplicity. He advocates for a straightforward approach to investment that anyone can follow. His method? It's as simple as buying and holding a diverse portfolio. This eliminates the need for complex investment strategies that often confuse beginners and even seasoned investors. Now, you may ask, what does buying and holding mean? Well, it's exactly as it sounds. You purchase a broad range of stocks and bonds and hold on to them for the long term. This strategy allows you to ride out the market's ups and downs without the stress of trying to time your investments perfectly. But how do you achieve a diverse portfolio without getting tangled in the intricacies of individual stock picking? That's where Bogle introduces the concept of an index fund. An index fund is a type of mutual fund that aims to replicate the performance of a specific market index. It's a simple, low-cost way to invest in a broad swath of the market. By investing in an index fund, you're essentially buying a small piece of every company in the index. This approach provides immediate diversification, reducing your risk compared to investing in individual stocks. The benefits of index funds are manifold. They're easy to understand. They have lower fees than actively managed funds, and they offer a simple way to diversify your portfolio. Furthermore, Bogle argues that because most fund managers fail to beat the market consistently, investing in an index fund that simply tracks the market can actually yield better results in the long run. So is simplicity the key to successful investing? According to Bogle, the answer is a resounding yes. By keeping your investment strategy simple and focusing on long-term growth through a diverse portfolio, you can eliminate unnecessary complexity and increase your chances of success. As Bogle puts it, don't look for the needle in the haystack, just buy the haystack. What if the secret to successful investing lies not in the stocks you pick, but in the costs you incur? This is a question that John Bogle, the author of The Little Book of Common Sense Investing, wants us to ponder on. Bogle's cost matters hypothesis is a cornerstone of his investment philosophy. It's a simple, yet profound concept that suggests minimizing costs is the key to maximizing net returns. Now, let's break down this hypothesis. When we talk about costs in the context of investing, we're referring to a variety of expenses. The most obvious one is the management fees. These are the fees charged by fund managers for their services. But here's the rub. These fees are charged regardless of whether the fund makes or loses money. So, while you might be feeling the sting of a bad investment, the fund manager still gets their cut. Over time, these fees can significantly eat into your returns. Then there's the matter of transaction costs. These are the costs associated with buying and selling securities. Every time a trade is made, there's a cost attached to it, and the more trades you make, the more costs you incur. This is why Bogle advocates for a buy and hold strategy. By minimizing the number of trades, you're also minimizing the costs. And finally, we can't forget about taxes. Depending on where you live and the type of investment account you have, you might have to pay taxes on your investment gains. These taxes can take a substantial bite out of your profits. So, it's crucial to consider tax-efficient investing strategies. In the grand scheme of things, these costs might seem like small potatoes. But Bogle warns us not to underestimate their impact. Over the long term, these costs can compound, significantly reducing your net returns. It's worth noting that this isn't just a theory. Numerous studies have shown that low-cost funds consistently outperform their high-cost counterparts. It's a testament to the power of the cost matters hypothesis. As Bogle states, in investing, you get what you don't pay for. So, the next time you're considering an investment, remember to look beyond the potential returns and consider the costs. Because when it comes to investing, every penny saved is a penny earned. What if time and patience are your greatest allies in investing? This question sets the stage for our exploration of the ultimate strategy, as outlined in John Bogle's The Little Book of Common Sense Investing. Bogle places great emphasis on the power of two seemingly simple concepts: long-term investing and patience. He posits that one of the most effective tools in your investment toolkit is time, and one of the most potent fuels for your investment growth is patience. This belief is grounded in the immutable principle of compound interest, often referred to as the eighth wonder of the world. To illustrate this point, let's consider a story from the book. Imagine two friends, Alice and Bob. Alice starts investing at 20 years old, putting away $1,000 every year. In contrast, Bob begins at 30, investing the same amount annually. Both retire at 60, having invested in a mutual fund with a modest annual return of 7%. Alice, despite investing for only 10 years, ends up with significantly more money than Bob, who invested for 30 years. The magic of compound interest, coupled with time and patience, worked in Alice's favor. But how does one cultivate patience in the face of market fluctuations and the constant barrage of financial news? Bogle suggests a simple strategy. Buy and hold a diversified portfolio of stocks. By doing so, you're not trying to beat the market or predict its movements. Instead, you're riding the market wave, letting the inherent growth of the economy work in your favor over time. This approach also helps mitigate the risk of making impulsive decisions based on short-term market events. As Bogle wisely points out, the biggest obstacle to your investment success isn't the market itself. It's your reaction to the market. So the ultimate strategy, as per Bogle, is a game of patience, played over decades, not days. It's about understanding the power of compound interest, embracing the virtue of patience, and harnessing the potential of long-term investing. Remember, time is your friend, impulse is your enemy. Why has this little book resonated with so many readers and had such a broad impact, one might wonder? Well, the answer is quite simple. The Little Book of Common Sense Investing has shone a bright light on the often murky waters of investing, making it accessible and understandable for the average person. In an industry often shrouded in complexity, John Bogle has managed to demystify investing. He's shown us that we don't need to be Wall Street wizards to grow our wealth. Instead, he encourages us to embrace simplicity, focus on the long term, and avoid the pitfalls of short-term speculation. But the influence of this little book extends far beyond the individual investor. It has been instrumental in the rise of index funds and passive investing. Before Bogle's work, the investment landscape was dominated by active fund managers who promised to beat the market. However, Bogle argued that most of these managers failed to deliver on their promises, and their high fees eat away at investors' returns over time. In contrast, index funds, as Bogle advocates, simply aim to match the market's performance, not beat it. They do this by investing in a broad basket of stocks, mirroring the composition of a specific index. This approach is not only simpler, but also cheaper, as it eliminates the need for expensive fund managers. As a result, more and more investors have been drawn to index funds, leading to a seismic shift in the industry. The broader impact of the Little Book of Common Sense Investing on the finance industry has been transformative. It has challenged traditional wisdom, disrupted established practices, and empowered everyday people to take control of their financial futures. In essence, the Little Book of Common Sense Investing teaches us that successful investing isn't about beating the market. It's about consistently participating in it. It's about understanding that slow and steady often wins the race, and that simplicity, patience, and common sense can lead to financial success.